The topic for today is life insurance illustrations, with a particular focus around the guaranteed and non-guaranteed values. When it comes to life insurance illustrations, there is a lot of information. And if I'm interested in looking at both the guaranteed and non-guaranteed values, I do need to have awareness on the different reports to generate with the particular insurance company that I'm working with. So if you're an agent in the industry, you know that there's a high level of compliance that goes into life insurance illustrations, how we're always supposed to send a full illustration, we're supposed to disclose the guaranteed values, but then sometimes you look at the guaranteed values and you say, this does not accurately represent what I want to show. Because you might show a policy based on the non-guarantees, an illustration displaying $10,000 per year, funded for 10 years. But then on the guaranteed elements, the guaranteed side of the illustration, under the tabular details section, you see that the first year is $10,000, but then the second year it's $10,530. The funding gets all wacky, and it's just confusing. It's confusing to you. You know it's going to be confusing to your client. The industry says you have to show this, and you say it's going to cause extra work, and on top of that, I might lose a sale. I don't want to have to go through all this extra stuff when it's meaningless, or at least we feel like it's meaningless. So today's video, we're going to provide training on awareness around life insurance illustrations, and then how to show additional reports while remaining compliant, but still providing accurate answers to our clients. So let's have some fun. We're going to talk about, again, the guaranteed and non-guaranteed values, and we've got up top full illustration. So in the life insurance industry, if you're going to provide an illustration or illustrations to your clients or perhaps prospects, if they're not a client yet, the industry does require that we show the full illustration. That is a compliance guideline. Now, when I had worked for individuals in the early years, I remember them always printing off 2 pages of an illustration that just isolated the numbers, meaning the client wanted to see, what does it look like if I pay an X amount of dollars for a certain number of years? What does my cash value look like? And then what does my death benefit look like? Simple. As I grew in the industry, I learned that that really shouldn't be done. So one thing I like to do is, if I want to highlight the number pages, is I'll send perhaps just the number pages, but I will accompany that with a full illustration as well. Or if I am just sending the full illustration, I'll highlight the number pages. I'll say on page 12 is the example we reviewed during our call or our last meeting. Or perhaps I'll put a recording together that provides me providing talking points around the number pages and other information that's important. The thing is, like, what the balance that I'm trying to find here is, how do I remain compliant, but at the same time make it convenient for a client and directly answer their questions? I don't want to give an answer that doesn't address their question at all, because this happens a lot in the industry. So how do we remain compliant while also making life very convenient for the client? That can be a challenge, but we're going to talk about it today. So with a life insurance illustration, we've got the non-guaranteed values, and then also the guaranteed values. The non-guaranteed values on a life insurance illustration are based on what? If we just run a basic illustration, that's based on the present dividend interest rate, and then also the current charges and fees for any riders that you have attached to the life insurance policy. For example, if we look at a PUA rider on a life insurance policy, many companies have different names for this, but take a company like Mass Mutual. You may already know this. If you take their PUA riders, what's available? You've got their AILR rider, and then you have their LISR rider. Depending on the product you select, and we'll focus on the non-guaranteed values first. Depending on the product, if you select their 10-pay or their 15-pay product, the charges are as follows: 7.5%. and 8%. Now, those are gross charges. We always want to follow the net cash value and net death benefit figures, but those are based on the non-guarantees. If we look at the guaranteed side of an illustration, those fees are actually increased to where they are both at 10%. And if you were to select any of their other products that were issued after 2022, meaning a non-legacy whole life product, you'll actually see that Ailer and Lister both start out at 10%, and Lister can be increased up to 12%. So those are some items we want to be aware of, but it demonstrates the fact that based on the non-guarantees, a rider can be attached, a PUA rider, and here are our current charges. But when we look at the guaranteed values on a life insurance illustration, that's going to assume that the company is assessing the maximum allowable charge, meaning what's the guaranteed maximum charge they can assess to your client's whole life insurance policy. And then in addition to that, when I look at the guaranteed values, no dividends will be applied. So it is truly an absolute worst case scenario. So that's one example of one rider. Another rider that we're going to discuss when we look at the case studies is a renewable term insurance rider. A renewable term insurance rider may be level based on the non-guarantees, but then it can increase based on the guarantees. Stay tuned for that. But back to this. So non-guaranteed values will assume 1, the company's present dividend rate, and then 2, the current expenses and charges. And then the guaranteed values will assume what? No dividends, and also the maximum allowable charge for riders and fees. And all companies are different. If you look at Guardian's PUA rider, the fee's the fee. Based on the non-guarantees or guarantees, the fee is going to be the same. It will either be the 5% PUA fee or the 10% PUA fee, depending on the product and PUA rider you select. So, why is this important? Well, a couple of reasons. When we look at a full illustration, so in a full illustration, we've got the tabular values and then the supplemental values. The supplemental values are what I prefer to look at because it demonstrates a custom fund scenario, which I'm going to come back to in a minute. But the supplemental values is what I prefer to look at. And the reason why is because it represents the custom fund scenario. So if I pick a product that is, let's say it's a whole life 100, how long are premiums payable in that particular product? Up until your age of 100. Okay. The tabular values will assume that the premium is paid up until age 100 no matter what. Whereas the supplemental values will represent only the custom fund period. So I might take out a whole life 100 policy and design it in a manner where I pay for 10 years and then I stop. I never pay another penny into it. The supplemental values will assume that 10-year funding scenario with zero out of pocket thereafter. Whether I exercise the premium offset, allowing the dividends and interest to pay the premium, or if I've exercised a reduced paid up, eliminating the premium. So the supplemental values demonstrate that, tabular values do not. The tabular values will also assume that any riders I attach to the policy are not removed, which I hate. Because if I take a policy, say it's a whole life 100, I add a term insurance rider for 10 years, and then I chop it off. That's what I actually do with my client. The tabular values will assume that that term rider is never removed. What happens if a term insurance rider is attached to a policy and never removed? What happens with the cost of that term rider? It goes up. If the cost continues to go up, what's going to happen to your cash value? It's going to go down. Or your client's going to be forced to pay more money out of pocket. So why I don't like that, the fact that the tabular values assumes I'm not cutting off a term rider or anything like that, is because it causes confusion. It shows a scenario that we look at and say, we're not going to let that happen. Like we will remove the term rider in this particular case, or we will reduce it. Like it highlights almost an unrealistic scenario. But based on compliance, it is something that we have to show. So we can In some cases, show a custom guaranteed values report, which is often referred to as a supplemental values guaranteed report. If you're going to show this, you still have to show that. The tabular values will always be included in the full illustration. But this is a nice report because we can get the custom guaranteed values or guaranteed supplemental values. I'm going to show you some examples of this. And here's what I always like to follow or help the client to follow, because if I'm them, this has helped me the most. Always look at the net or total values. And this is with respect to the total cash value and the total death benefit, both on a guaranteed and non-guaranteed basis. Because when we start to look at the dollar charges and the percentage charges for PUA fees or term riders, whatever we're adding to a whole life insurance policy, one can look at that and get very, very nervous. But the thing is, those charges, especially if it's a percentage, does not always accurately represent what's actually happening with my policy. So to go back to the PUA rider, this is a great way to demonstrate it. If we take a PUA rider fee with Guardian, let's say it's their 5% PUA fee. If you pay in $100,000 into a PUA payment, a large PUA deposit, 5% of that is what? Well, that's simple math. It equals $5,000. So if you're a client, you see in your contract and on the illustration that the company charges a 5% PUA fee every time a deposit is made. Before you throw in $100,000, how much do you think is going to be withheld or will go to the insurance company? I would think $5,000 from the client. However, when you look at the actual policy value, what you'll see is in the first year, that'll come out somewhere between $2,000 to $3,000, which is 2 to 3%. Then by the time you hit the second and especially the third year, what you'll find is I've got that fee, but the policy is also compounding, so I don't see a negative impact all the time. And we've got some content that specifically covers PUA rider fees that breaks it down year over year based on the guaranteed values and non-guaranteed values, so I can see the net numbers. But my point is here, this can be scary, but it doesn't represent the actual numbers. So a solution here that has brought a lot of clients peace of mind is to, again, look at the net figures, net cash value, net death benefit, which will reflect the net or total cash value and death benefit after all of your premiums are paid, after all rider charges, all fees, all dividends and interest, everything is deducted and applied to your policy. Here's my total cash value or net cash value column. They mean the same thing, just depending on the company, the terminology might differ. So we're going to look at a couple of examples here. And this should help quite a bit. We're going to look at a case study of two clients a little bit older in their 60s, which is a good case study to look at because when you're in your 60s, when you're attaching riders, what happens? They get a bit more expensive, don't they? They do, especially for term charges. So it allows us to see a true worst case scenario and also know what to show the client or what to make them aware of, because again, we have to show everything or provide everything, but I don't want a client to panic. And I don't want to panic either because of a lack of awareness, which trust me, I've done many times. So let's take a look here. Why don't we look first at the 65-year-old individual considering a Mass Mutual policy. They are considering a 10-pay policy. Now a 10-pay policy has premiums due how long? The base premium is due for 10 years maximum. What's the guaranteed rate here? The guaranteed rate with that product is as low as you'll see it with a whole life insurance policy. 2%. What's Mass Mutual's 2023 dividend interest rate? 6%. Now, when you look at the dividend column on a life insurance illustration, does that reflect the dividend rate of 6%? No. Remember, the guaranteed portion is not included in that column. And you'll see that if we have a chance to go through it. So let's take a look at this first. But what I want to focus on are the non-guaranteed values and then also the guaranteed values. So here we go, a recent illustration. And what we'll look at here is as follows. Why don't we scroll down a bit? So we've got an illustration summary, which is based on the non-guaranteed values. The only time this will be different, particularly with MassMutual, is if you run the state as Texas. But here's what I want to do. Scroll down. Let's go to the tabular values first. So what I should actually begin with is the planned funding with this policy. So what she wants to do is fund the policy years 1 and 2 at $90,000 per year. That's her plan. Years 3 through 10, she wants to fund the policy at $50,000 per year. Now it's designed to be very flexible. I'll go over exactly what the base premium is, how the flexibility works. Pretend this is you and this is your plan. This is exactly what you want to do. You receive an illustration based on the state you reside, and here's the tabular values. So, what do we have here? Contract premium. 90,000, 1 and 2. Then what do we have? 50,000 through the 7th year. And then what starts to happen? Goes up a little bit. Why does that happen? Look at this. Guaranteed values. What do we see here? First year is what we're going to pay in. But year 2, look at this. Jumps up to $95,000 and change. And then year 3, where the plan was to pay $50,000 per year, $56K, and it continues to increase. Here's the reason why. And this is important. It's especially important for a couple of reasons. One, this policy has a $90,000 MEC limit. So based on the guarantees, if this actually happened and was paid by the client, it would trigger a MEC, which we could easily reverse, provided we do it within 30 to 60 days, but still, we don't want that to occur. And then secondly, throws off the values. Breakdown. Where's the money going? Here's my base premium. Here's my initial LISR payment. Here's my initial AILR payment. Remember LISR? It's a combination of 1-year term plus PUAs. I'm a fan of it with MassMutual products because it does build in flexibility that typically does not exist with MassMutual. MassMutual is not super flexible. If you've got that rider attached, it can be very beneficial for a client to reduce payments, then increase them again in the future. We've seen a lot of people appreciate that. Scheduled AILR, their pure PUA. And then what's this? Renewable term rider, 1605. What's going on there? So with the 1605, that is the premium for the term rider. And here's how MassMutual works with their RTR, renewable term rider. It is a level premium for the first 10 years based on the non-guaranteed values. However, based on the guarantees, they reserve the right to begin to increase that renewable term rider premium starting year 2. This was a change they made as a result of the 2017 mortality table update, which went into full force, went into effect in 2020. I have not seen them personally actually increase the renewable term rider premium for policies that we have written. However, they do reserve the right to increase it. Very, very rare. I would think that they would actually increase it. They likely will keep it level with most policyholders. That's my opinion. But it can be increased, which is why we see the increase over here. So important to be aware of that. Now, as we scroll down a bit here, the plan was what? To fund it for how long? For 10 years. What's happening here after year 10? If this is you, what would you think? My plan, Steve, was to pay into it through year 10, 90K years 1 and 2, and then 50,000 per year thereafter. Yet here it gets all wacky, and this says it's guaranteed, which makes me a little bit nervous as a consumer. You ever have a client or prospect tell you that? I'm getting very nervous here, and not our best moment. I know I've been told that, especially in my early days, and I started to panic, man. Like, I'm freaking out. I don't know what to do. Rest assured, keep a cool head. It'll all be okay. But then here, look at this. Premiums increase. What about over here? They increase as well. Here's what's going on. So it's a 10-pay policy. The base premium payment stopped after year 10. The Tabular payments in this example stopped after year 10. The renewable term rider and the supplemental values based on the client's actual plan, we removed it after year 10. However, in this case, the tabular values assume that it will never be removed. And what happens after the 10th year based on the non-guarantees? It begins to increase, especially as we get older. When we look at the guaranteed premium, that just becomes ridiculously high. So this, again, is a very, very easy fix because we can just simply cut the term rider, which we would do in this particular case. But the tabular values, which reflect guaranteed values, do not show this. Hence, confusion for the client, sometimes confusion for the agent, right? Have you ever felt confused with this stuff? It can definitely happen. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.